Good morning, good afternoon, and good evening, everyone, and welcome to an economic update for small business owners, the first event in our Tools for Your Financial Wellness series with Bank of the West. Also, happy National Small Business Week, everyone. My name is Colin Mahan, and I'm the Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you will see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. I have a couple of housekeeping items to cover before we get started. Firstly, let us know where you're dialing in from in the chat. Shout out where you're coming from. Secondly, we're going to open up our live Q&A near the end of the event, so please submit those questions for us in the Q&A function at the bottom of your screen throughout their presentation. We will try our best to get to them all. Now, none of what we do here at the center would be possible without all of the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We're humbled by their contributions and hope you're grateful too. Now, before we get started, I'm going to launch a few polls to take a quick step back and take a temperature gauge on how all of y'all are doing today. We use this information to guide the programs and resources we provide to you, the entrepreneurs we serve. So the first one, how are you feeling about your business? Are you optimistic? In a bit of survival mode? Are you anxious? Hopefully optimism is on the rise, but understand that entrepreneurial journey is a wild ride sometimes. Thank you for voting. I'm going to leave this open for just another moment. Looks like optimism is in the lead, so I'm going to share these results. But there is a little bit of anxiety in survival mode. Hopefully our presentation today will help alleviate some of that anxiety. The second poll I'm going to launch here, what is keeping you up at night? Is it finance, sales, marketing, scale, pivot, team, or survival? We use this information to guide the programs we're going to be hosting in the next couple of months. So thank you all. As I let this poll run, let's see where y'all are coming from. Lakewood, Colorado, Texas. We got Long Island, New York. Welcome, welcome. Toronto, Davis, High Point, North Carolina. All righty, bunch of time zones here. Sacramento. We've got some Petaluma. Columbus, Ohio. All righty, welcome. So I'm going to end this poll and share those results just so you know. Finance is at the top of the key given our conversation today. Hopefully we'll be able to help with people much smarter than myself. So without any further delay, please join me in giving a warm welcome in the chat to our special guest and host of our conversation, Rita Dailey, Head of Product Segments and Client Delivery for Small and Medium Enterprise Banking at Bank of the West. Rita, welcome.
Well, thank you, Colin. And I'm going to add my happy small business week to everybody as well. And I'd also like to say that Bank of the West is super proud of our partnership with your organization, Colin, and the ability to do great events like this. So
we're happy to have you.
Thank you, all of you who have tuned in today. As Colin mentioned, this is part of a 3-event series today, tomorrow, and Thursday, where we're really focused on hopefully adding some value, information, and tools that will be useful to the small business community and entrepreneurs that we serve. This year's theme for Small Business Week is building a better America through entrepreneurship. So on that note, we'd like to really focus today on what we think is a top of mind topic that will impact your business, and I know even is top of mind for all of us personally. And that is, where's the U.S. economy headed? How's it going to impact me? How's it going to impact my business? And importantly, how should I be thinking about it and preparing, for the rest of this year into 2024? And I'm just happy to say we have an expert with us today, Dr. Scott Anderson, who is Chief Economist at Bank of the West. And he's going to give us an overview, a presentation on a little bit of a primer on the economy right now and some key insights. And then along the way, we'll be talking about things that small business owners should be thinking about as they head into what we know is a bit of a softening economy. So Scott, I'm going to hand it over to you. And if you wouldn't mind just giving the audience a brief overview of your very impressive bio.
Thanks, Rita. Thanks for that introduction. And thank you all for joining today. Just really thrilled to be here and be a part of this Small Business Week with Bank of the West and the Nasdaq Entrepreneurial Center. My name is Scott Anderson. I'm an Executive Vice President and Chief Economist for Bank of the West. I've been a professional macroeconomic forecaster for around 25 years. I started at the International Monetary Fund in Washington, D.C., Moody's Analytics in Philadelphia, but I've spent most of my career being an economic forecaster for the banking industry, half my career at Wells Fargo and about half my career here at Bank of the West and now part of BMO. My daily job is to forecast international, national, regional economic trends. I really specialize on the U.S. economy and monetary policy, as well as the California economies, but well-versed in monetary policy, interest rates, and of course, we're keeping a close eye on what's going on in the banking industry right now. So hopefully y'all can hear me all right. I think I'm ready to jump into my presentation. So hopefully you can all see the slides here. I've got a short 10, 15-minute presentation for you all to kind of kick off the conversation and discussion. And then at that point, we're going to be opening it up for some Q&A. We've got some pre-submitted questions, but we've also got, I think, an opportunity for folks to ask questions on the fly here as we go along. So that's a little bit on the run of show. So let me start off by saying kind of where we're at. I think nobody has a perfect crystal ball right now. There's a lot of uncertainty. This pandemic, to be quite honest with everyone, has been one of the hardest to forecast. And I've been doing this for 25 years. I forecast through the dot-com bubble. I forecast through the Great Recession and financial crisis of 2008 and 2009. But I think this pandemic has been one of the most challenging of my career. Where I think we're at right now is I think the U.S. economy is right now in that unfamiliar twilight between boom and bust. And 2022 was a transition year. So 2021 was just, rocket growth, growth, no holds barred growth. And of course, inflation. We dealt with one of the tightest labor markets in the United States. Got to go all the way back to 1969 to see a labor market as tight as what we've been seeing over the past year. We also saw one of the fastest inflation rates, as we all know, in about 40 years. And of course, that's prompted now a sharp response from the Federal Reserve to tighten monetary policy, to raise interest rates, to make it a little bit harder for folks, a little bit more expensive for folks to borrow. And we've seen the fastest tightening by the Federal Reserve, which we think we'll continue to see at least one more rate hike this week for the May meeting that we've really seen, the tightest monetary policy we've really seen since the 1980s. So all of this, of course, is designed really to slow down and soften the economy, expected to weaken consumer and business demand, slow job creation, and bring inflation down from the peak where it was last year, over 9%, down to something that the Fed can deal with, which is closer to 2% target. So that's kind of where we're at. So we're really in this transition period. I think 2023, unfortunately, is going to be the year where we see a lot of that monetary tightening really come home to roost on the U.S. economy and over in the financial market in general. I think what we've recently seen since March, the failure of Silicon Valley Bank, Signature Bank, and now just past a few days of First Republic Bank, are just really the opening rounds and consequences of what the Fed has done over the past year in terms of raising interest rates. So where do we go from here? If we go to the next slide, again, kind of highlighting the theme here, we really were in a boom situation over the past year, really unprecedented job growth in the United States. So in the past year, the US economy has already been able to create, through March of this year, still over 4 million US jobs. A lot of that's coming in education and healthcare, leisure and hospitality. As people are traveling again, we're seeing the airports filling up, hotels filling up. Everybody's anxious to see their family members they haven't seen over the past 2 or 3 years throughout the pandemic. So you're seeing a lot of activity there. Professional and business services, hopefully your small business or the business you're starting is in one of these sectors, is also quite strong. Where we're starting to see some softening is in information services, which is really the technology sector, and financial services, because of the turmoil we're starting to see now in the banking industry. You're going to start to see some more softening there, and that will feed into, we think, construction, retail, trade, manufacturing, some of those traditional cyclical sectors. But it's the downturn. At this point, we haven't really downgraded our forecast. The good news is we haven't really downgraded our forecast on the US economy for this year based on what happened to Silicon Valley Bank. I think it's raised the risk of a recession sometime this year, but I haven't made my recession forecast any more severe because of it, because I think there's been a number of important steps taken to stabilize the situation. There's a lot of things going for the economy right now, still on the momentum side, really coming from the consumer and the labor market. That's going to carry us through a little bit this year. If you go to the next slide. So what are small businesses telling us? Well, the best data we have is survey data come from the National Federation of Independent Business. And a testament to the strength of the labor market, which I think continues to this day. We're going to get another read on the job market for the month of April at the end of the week. But small businesses are still telling us that they're still having a pretty incredibly hard time filling open positions. There's still about 9.5 million open positions in the United States. That's about 2.5 million more job openings than there were prior to the pandemic. So while we're cooling off, the labor market and monthly job growth is slowing down, is still a very, very tight labor market. And I think small businesses are going to continue to have to deal with that to some extent this year. If we go to the next slide. But why are we so downbeat about the outlook for the economy? Well, I think we're still trying to digest a lot of the monetary tightening that we've seen from the Fed over the past 12 months. And by the way, the Fed isn't done doing that. At the same time, they're shrinking their balance sheet. So we're seeing a lot of the leading indicators of the US economy, things like housing starts, the stock market, credit spreads, access to credit, consumer confidence. All those sort of indicators have been weakening really since the Fed started raising rates last March, and that continues to now signal a recession ahead. These leading indicators tend to forecast a U.S. recession about 3 to 6 months ahead. So we don't, economists are notoriously bad at being able to give you the exact time and date of the recession, but it does look like it's fairly imminent here, maybe starting by the end of the second quarter or early in the third quarter, and probably lasting for much of the year this year before we'll see some relief. If you go to the next slide. We're already starting to see, especially here, I'm sitting here in the Bay Area, San Francisco, California, and we're really at the leading edge. I kind of say we're the canary in the coal mine of what we expect to see a little bit more visibly around the country in the months ahead. We're really starting to see those layoffs start to pile up. And it's really started in the information services technology space. These are eye-popping percentages in terms of increase in layoffs. This is from the Challenger Gray and Christmas data. So it really does seem to be focused right now on technology, but we're now starting to see layoffs beginning to occur in a broader cross-section of industries, even telecom, nonprofits. One thing we are seeing is California and the West Coast of the US seems to be getting hit a lot harder in terms of layoffs than the rest of the country is right now. But I do think this will start to spread around the country. In fact, last month's data in the Bay Area looked recessionary already. We were seeing net job loss in the Bay Area. So I do think some of this is going to be showing up a little bit more visibly in the national data in the months ahead. Go to the next slide. So what does that mean for your ability to surface new employees? Well, the good news is we are rebalancing the labor market. Labor demand continues to ease. Labor supply has improved as some of the pandemic assistance has worn off. We've seen more and more folks re-entering the labor force. Labor force participation rates are not quite back to pre-pandemic levels, but have come up nicely over the past year. All this means that we're going to go to a situation a little bit more balanced in the labor market. The way you can see that is in the unemployment rate here. We do expect we're going to go from about 54-year lows on the US unemployment rate to something close to 5%, I think, at the peak unemployment rate sometime in the first quarter of next year. So it will take some time to play out. I think a lot of that weakness is going to show up in the second half of 2023, and it'll probably linger into 2024. But I do think it'll be a better environment for small businesses that are still looking to expand and grow their businesses to be able to get those employees without having to pay exorbitant rates and wages to attract those workers. If we go to the next slide. And why don't we think this is going to be a repeat of 2008, 2009? Obviously, we're starting to see some bank failures. Again, everybody has flashbacks of the Great Recession and the financial crisis in 2008 and 2009, which was one of the worst recessions in my lifetime. Lasted about a year and a half. We lost about 9 million US jobs over that period of time. Why do we don't think that's the case? Is the consumer going into this downturn from tighter monetary policy is actually in pretty good shape. There's been a lot of pandemic assistance, not only from the Federal Reserve, but also from the federal government. Biden and President Trump has spent about $5 to $6 trillion on pandemic programs. And of course, Biden has followed that up with the CHIPS Act and Inflation Reduction Acts. So all this fiscal spending is continuing to wash over the economy. And as a result, consumers have been able to squirrel away a considerable amount of money. By our estimation, consumers are still sitting on about 1.9 trillion in excess savings. These are savings above and beyond what they were able to squirrel away and save before the pandemic. Now, inflation is eating that away, no doubt about it. Over the past year, inflation has taken away about $720 billion of those excess savings for consumers, but overall, the consumer is pretty good shape. The other data we look at is consumer debt service burdens. Now, as interest rates go up, people are having to pay more on their credit cards. Maybe if they go buy a car, they're having to pay more on their auto loans. Or even if their mortgages is an adjustable rate mortgage, they might start to see those adjustments starting to take hold. But overall, debt service burdens for consumers are really just back to pre-pandemic levels. And actually, people have been able to take some of that excess savings and actually pay down their debts. So we've actually seen the debt accumulated from consumers have actually dropped as a share of the economy by about 25% of where they were before the Great Recession period. So again, there's a lot of things going well for the consumers, including a very tight labor market with strong nominal wage growth that's going to keep the consumer in pretty good shape. And we only expect a very mild downturn in consumer spending that could last maybe 6 months or so. If we go to the next slide, you can see what we're seeing. We're seeing a lot of consumer spending bouncing around. The trend is really for weaker and declining real consumer spending as the Fed again kind of takes away the punch bowl from this boom situation we've been in. We saw a little bit of a head fake in the first quarter consumer spending numbers and the GDP numbers. And the reason was January, we saw a huge spike in real incomes and real consumer spending in January. It rapidly went away in February and March, but it was really driven by the government and their 8.7% increase in their cost of living adjustment for Social Security. So it was a kind of a one and done sort of situation. We don't expect that, of course, any sort of increase like that to be repeated. So I do think the consumer is going to have more headwinds, I think, as we enter further into the second quarter and the third quarter of this year. If we go to the next slide, you'll see our forecast, or my forecast, on real consumer spending going forward here. Now, we've seen a little bit of a pickup in consumer spending in the last few quarters, if you take out the fourth quarter last year. And so the consumer has actually been balancing, there's still very strong spending power against the still very high inflation. I think what the Fed has done over the past year will probably get the better of the consumer, especially as the labor market continues to soften, and we'll see some of that consumer spending hit maybe as soon as the second quarter into the third quarter. We do expect a gradual recovery next year, but it's going to be a gradual recovery because we think the Fed's going to be very slow to reduce interest rates and their restrictive monetary policies this time. Unlike 2008 and 2009, when the Fed was very quick to cut interest rates to zero and to institute a number of credit facilities to help the economy. This time around, they're going to be reluctant to do that because of the still very high inflation. If we go to the next slide. So we're already seeing evidence of the softening in the consumer and overall business environment from small business optimism. It's come down substantially since 2001, and we're actually back at pandemic lows in recent months. So it's not falling off a cliff, but it certainly could be better. And again, this is a sign that some of those headwinds are continuing to mount for small businesses. Not only are we seeing some weakening in some of the sales and revenue outlooks, but we're continuing to see cost pressures, again, difficulty in hiring workers, and that's squeezing small businesses' profit margins. If we go to the next slide. So what is the inflation outlook? Our view is that current conditions, inflation's still way too high. It is starting to come down, especially for goods inflation, but we're continuing to see very sticky inflation overall, really coming from the service side of the economy and also housing. Even though rent growth is starting to soften, we really haven't seen that feed through into the CPI or inflation numbers for the consumer. What we're seeing and hearing from consumers in the survey data, latest data, is they're still seeing a lot of inflation right now, almost double-digit inflation, things like medical care, tuition, and still pretty high inflation in things like food, though it's starting to come down, and gasoline and other commodities. So it's going to be a while before we get back to that 2% inflation target, though we think, on the right track. If we go to the next slide. So here's what we expect we'll see with inflation going forward. Again, we peaked at around 9% inflation in the middle of last year. It's coming down nicely. We're sitting at around 5% inflation as of March, and we think that's going to move down to something a little bit above 3% by the end of the year. Still above the Fed's 2% target, but certainly much closer to the Fed's target. We think by the middle of 2024 or second half 2024, we'll be much closer to the Fed's 2% target here. But it will take a challenge here, and we'll take more softening in the labor market for us to get there. If we go to the next slide. So there's going to be a little pain before the gain, so to speak. What small businesses are telling us is they are starting to see some reduction in their pricing power. We are down from the peaks in terms of small businesses being able to pass on higher selling prices. The good news is on the input cost side, at least in terms of their inventory and things, it's starting to get a little bit cheaper. as well. So it's still a balancing act for small businesses, but that's another sign that maybe some of the strongest demand days are behind us, and we'll still see some more rebalancing. Again, we're not back to pre-pandemic levels, so we're still, in relative terms, still looking at a pretty good, strong pricing environment for small businesses and a pretty strong consumer demand environment right now. Go to the next slide. So again, I've alluded to the fact that the Fed's going to be taking away the punch bowl, or already has kind of taken away the punch bowl. We're just kind of waiting for the next shoe to drop here. I think the fact that we're seeing bank failures and liquidity issues and bank stocks going down, I think that's a pretty good red flag that we're seeing tighter liquidity. We're going to see tighter credit conditions, probably tighter financial conditions in the months ahead. By the way, it doesn't help that we're right in the middle of a debt ceiling debate in Washington, D.C. Yet again, we're about a month away from the federal government not being able to pay their bills. If we don't get a suspension of the federal debt ceiling or an increase in that debt ceiling by June 1st, according to Treasury Secretary Yellen, the U.S. government is at risk of default. And I think some of the volatility you're seeing in the stock and bond markets today are a sign that the investors are now starting to get a little bit more worried about the ability of the Republicans and Democrats to come to some sort of compromise agreement. So outside of the Fed, I'd say the debt ceiling right now is our second biggest risk. I think it is in our baseline forecast that the U.S. government's going to default. We've never done that before, and we've always, even in these last minute sort of negotiations, we've always come down on the side of solving it at the last minute. But there could be considerable volatility in the markets, in the stock market and bond markets in the next month or so. I do think Treasury yields are going to remain high. The Fed isn't about to cut rates because of the current inflationary environment. I think by next year, they'll be in a position to cut rates. Probably by March of next year, we think the Fed will start to cut interest rates, but they'll have to wait. We think there'll be one more rate hike from the Fed at the May meeting, another quarter point increase, and then they'll hold at that level until March of 2024 before we start to see some cuts. What that means is the yield curve will probably remain inverted. Net interest margins for the banking industry remain in trouble, and that's going to continue to put financial pressure on the banking industry as well as on small businesses and their access to credit. If you go to the next slide, and we're about to open this up for questions here. Just got a couple more slides. Even before the failure of Silicon Valley Bank, Signature Bank, and now First Republic Bank, we're already seeing banks reporting that they were tightening credit standards really across the board. What I'm showing you in this chart is really just one of the most problematic sectors, which is the commercial real estate market, specifically the office market, where we think there's more pain to come. But we're seeing banks tighten credit now across the board, and even in a lot of their consumer portfolios, including credit cards, autos, and et cetera. So this will have knock-on effects for consumer demand, consumers' ability to access credit, and also small businesses' ability to access credit, and other businesses' access to credit going forward. Go to the next slide. I do think the Silicon Valley Bank failure and other bank failures will accelerate that tightening of credit and maybe even push forward the day of recession a little bit. We're already seeing small business reporting tighter credit conditions. And actually, they were the worst in the decade. If you look at the March data, this was right when the bank turmoil started. So still early days in the tightening bank credit story. But again, small businesses are certainly getting much more worried about their access to financing, especially if you're trying to grow your business, expand your business, or you're in the startup situation. This is, Silicon Valley venture capital was already quite scarce. This could actually make the situation worse before it gets any better. So if we go to the next slide. And so what we're seeing is consumers are reacting to this. We are seeing a slowdown in demand for consumer loans pretty much across the board. It's really being driven by a slowdown in auto loans, but we're actually starting to see credit card demand starting to drop as well. And on the business side, we are starting to see weakness outside of commercial real estate and just regular business C&I lending as well. So I think this is the start. We're looking for the data that's going to be coming out next month or two to give us a better read on how tight this credit crunch might get. Still early days. We're still seeing bank failures, so there certainly could be a potential here for things to get quite a bit tighter before they get looser. Go on one more slide. So kind of putting this all together for you, kind of a national view here on our GDP forecast. Now there's obviously things you can do as a small business to grow your business, even in tough and challenging economic and financial times, but it certainly is going to be a trial period. And it's not going to be as easy to make money as maybe as it was in 2001 or early 2022. We are looking at about a 2-quarter recession right now. I think as the Fed starts to cut rates in 2024, we'll start to see some improvement, though we do expect only a gradual recovery because we think interest rates are going to be slow in coming down, probably slower than what the market has been pricing in. We're starting to see the market trying to factor in some rate cuts before the end of the year. That is not our view, and I don't think it's the majority view of the Federal Reserve either. If you go to the next slide. So that's the conclusion of my prepared remarks. If you go to one more slide, you'll see some of my contact information. My email there. If I think they're going to make available these slides for everyone, maybe on your website. But at this point, I think we're ready to transition to some of the Q&A. So again, thank you for your attention. I hope you found that informational and helpful for you as you manage the next 4 to 6 quarters going forward. And so back to you, Rita.
All right. Well, thank you, Scott. And it's the data is the data, and it is it's a little bit gives everyone pause. But that was a great overview. I think one of the things, as I think back to the pandemic, which was one of the biggest shocks we've had ever, unexpected shocks, we did see businesses get hurt and benefit unevenly, and also we saw a lot of business owners, very smartly and very adeptly sort of pivot. I'm in the food business, and then suddenly I'm in the food delivery business, and as the retail, sort of storefront went away. How do you see in this environment, and I know it's not easy to do, but where do you see the industries that may benefit in this environment versus those that may need to pull back and be more conservative?
Yeah, thank you for that. And I do want to comment on your comment, Rita, which is that small businesses were remarkably resilient during this pandemic. I mean, we had 22 million people lose their jobs. A lot of restaurants and bars and other service businesses, small businesses, had to close almost immediately and for several months. And so, coming back from that, and then with the shortage of labor on top of it, really an unprecedented amount of challenges, but the resilience of the economy really shone through. I do think some of the pandemic assistance helped in that regard, including the PPP, which Bank of the West was very willing and able to lend to our customers, and it really helped them get through the trial period there. In terms of what industries may be more heavily hit, there's certainly this downturn, while it's going to be mild by historical standards in terms of job loss and maybe decline in GDP, it is going to hit different regions of the country and different industries harder than others. It's a little uncertain because of the pandemic's uniqueness, because we did have, for example, leisure and hospitality is one area that tends to get hit really hard in a recession. It's more discretionary type spending. People can put off going on trips, but hey, we're coming out of a pandemic over the past 3 years where people weren't able to see their family members. So I think you're seeing a little bit of that dichotomy going on right now. And by the way, consumers still have quite a bit of spending power to kind of power through all this uncertainty. So that's why we don't think it's going to be quite as severe. But we do look for a lot of those discretionary sectors of spending where consumers can maybe pull back without, not the necessities, obviously groceries, filling up your gas tank. Those are things you have. Paying your rent or your mortgage are certainly high priorities, or even your credit cards. But people will be pulling back a little bit on those durable goods type spending that we saw. We're always seeing good demand coming down quite strongly. We think auto demand will be weaker. Even in housing, we're seeing weakening in home sales, et cetera. So that's another area. And we're seeing it also starting to play out. If you're the small businesses that sell to manufacturers or the goods side of the economy, even in construction, while it's still quite strong because of public projects, we are starting to see some slowing of multifamily, residential. Of course, office and retail are going to be quite weak going forward as well. So it's a little bit of a mismatch there, but hopefully that gives you a little bit of a flavor of where we see some of the weakness going forward. I mean, if you're in the retail space and you're selling furniture, that's going to be one area that's going to get hit hard, right? But in terms of bright spots, I think the like leisure and hospitality, there's going to be some areas like, hotels where occupancy looks back to normal or even better than normal in some sense, and in some areas of services spending where we think consumers are going to keep spending. But if you're a Netflix or you've benefited from the work from home or the Zoom meeting era we've been in, those sort of businesses are seeing a challenging environment right now, partly because they overexpanded during the pandemic and now they're having to backpedal to right size their supply and demand.
Great, thank you. Since it's what we both know, I'm going to pivot over to banking a little bit and talk about both on the deposit side as well as credit availability. So on the deposits, you talked about it, the sort of implosion of these banks. And I think we know in part in how they were managing their balance sheets and all of that. But do you see that as, be continuing, or do you see that as a, it sort of will run its course here? And then how should small businesses, in your opinion, be thinking about, where to place their funds, how to think about that?
Yeah, good question, Rita. So I'd say a couple of things. I think the good news here, I think we're through a lot of the first stage of this banking turmoil, or I don't want to use the word crisis, but that's been used. One thing to point out is this is not a repeat of 2008 and 2009. What we saw happen to the banking industry back then, if you remember back in those good old days or bad old days, it was really a credit problem, a credit crisis really emanating from the residential housing market and the over lending and bad lending underwriting that went on then. This time around, it's more the Federal Reserve that's raised interest rates so aggressively that a lot of the securities that a lot of banks put on their balance sheets, be it treasury bonds or even mortgages or commercial real estate loans, are now only giving those banks low interest rates. And now, of course, they're having to pay more to attract their deposits to lend that out. And so what we're seeing is that the net interest margins for the banks are in some cases negative. And that's putting pressure on bank liquidity and capital. So those banks that didn't diversify, that were in a niche market with a niche customer, they're the ones that have gotten hit the hardest. I don't think this is a broad-based problem for the banking industry in general, though I do think the environment for banks is going to continue to be challenging. So I don't think it's going to, I can't say we won't see another bank failure out of this. Just today we saw a lot of pressure on regional banks yet again. But we don't see as much collateral damage downstream for credit conditions and for consumers and small businesses. So if you've been a well-run business and a diversified bank that has, at BMO Bank of the West, we've got millions and millions of customers. We're in, 2 different countries. We're in all kinds of businesses. So our banks have been able to benefit, and the bigger banks are benefiting from all this. So it's not hitting all banks the same, but some of the smaller regional players are getting hit. And I think regionally, we're going to see some more tightening here, probably in California, the Bay Area, than we're going to see in other areas. But if you're still a good business, well-run business with good cash flow, a strong business model, and good, healthy balance sheet that hasn't taken on too much debt or too much risk, I think there's going to be a number of banks that are going to be continually willing to lend to you in the days and months ahead.
Yeah, I'd add to that. It's like the way I think about it, if you were going out to buy insurance or whatever it is that you're doing, you want to know the soundness and of who you're dealing with. And I think the same applies to banks. So I know we've been talking to our clients about, just safety and soundness. And while the FDIC insurance is there as a backstop and important, up to $250,000, you really don't want to go through that process of getting in line with the FDIC to collect your funds, although it is a government guarantee. So at that level, you have that protection. But I think it's like anything else. It's disruptive when you have to take your account from one place to another and all of that. So I think it's just making sure you're dealing like a solid financial institution, whoever your bank is, that they're not going to be in that situation of a liquidity crisis.
You're absolutely right, Rita. And to your point, I think this really highlights, for small businesses, know your banker, know that banking relationship. And I'd also say, be careful of those teaser rates, right? Those rates that some banks offer to try to attract new business. You want, a bank that you have a long-term relationship with, that have been with you in the up times and the down times. Because they're going to be around for a long time. Sometimes those teaser rates are actually a little bit of a red herring. It means that the banks are really in need of liquidity, might be in some sort of trouble. So just keep that in mind, I think, as you try to navigate this from a banking. And you might want to diversify. The good news, though, with what the FDIC and Treasury and Fed put in place right after the Silicon Valley Bank failure, is they are kind of honoring depositors, even if you're above that $250,000 FDIC threshold. And I think that's going to continue to be the case. Even First Republic Bank, that just failed recently, they're honoring, JP Morgan Chase is honoring all depositors, including those over 250. So there's no government guarantee of that, but I do think that given the precedent of what we've seen so far, we're likely to see those deposits covered for most folks.
Yeah, and I'm just going to pick up on your point about, and I think it is harder for small businesses. I know it is, because small businesses oftentimes, they're in a branch and it's hard to form those relationships. And, let's face it, banks have had turnover just like any other industry. But to the extent you can really get a good relationship, and you should be picky about it, right? Not all bankers are created equal. And because when you get in those hard times and you need credit, on the margin, if you have someone in a bank that understands your business, can articulate that, and really explain within the bank on why this is a kind of money good loan, if you will, that can be very helpful. So I think your comments about that, trying to keep a long term, and it doesn't always, you don't always get it the first try, And as your business evolves, you may need to evolve and move up within a bank in terms of the type of the person's expertise that you're working with. On the inflation side, I wanted to ask you a little bit. The graphs were good and kind of looking at how that inflation is going to come down. But wages have gone up, and it's hard. It's hard to say to an employee, "Hey, we're going to pay you less." So some of this inflation is permanent, in a sense. How should we be thinking about that?
Yeah, I've been again skeptical that the Fed's going to be able to ease off the brake pedal quickly here, because inflation tends to be quite sticky. And I think even the Fed has been surprised. At first they were saying inflation was going to be transitory, and then they kind of abandoned that. And now they're kind of resigned to the fact that inflation is going to be sticking around for a while. And I think we can continue to be disappointed in terms of how rapidly prices come down. Now, we can continue to get hit with different shocks, to be quite fair to the Fed. We had the war in Ukraine. We continue to see OPEC plus cutting oil supply, which continues to shock energy prices. So there's a lot of things that can come out of left or right field, which is going to keep the pressure on the Fed. What you brought up, Rita, is on the wage environment, and you're absolutely right. We've seen, with the tightness in the labor market, where we're at, the tightest labor market in 54 years, we are seeing stronger nominal wage growth, especially if you're in one of those low wage industries like leisure and hospitality or retail. You've been at the forefront of those wage pressures, and it may be even harder for you to attract workers, even as you're paying higher wages. Now, the bad news is we're not seeing a lot of evidence yet of relief on the wage front. I was just looking at the Atlanta Fed's wage tracker, which is still, nominal wage growth is still tracking at or over 6% growth rate year over year. That's about double what we normally see from wages overall in terms of growth. And it's a lot higher than where the Fed really wants to see it longer term. So again, that's why the Fed's not really done with this inflation battle yet. And a lot of employers, including small businesses, are going to continue to have some trouble servicing workers still over the next probably 6 to 12 months. I do think we're moving more into balance, into supply and demand. But as I hope my slides illustrated, they're still imbalanced on the side of too much demand for labor and not enough supply. So we need more rebalancing for that to occur.
Great. I think, Colin, we'll kick it over to you to see what we have in the chat in terms of live questions, if you want to pop in.
Awesome. Thank you so much, Rita, for facilitating that. And of course, Scott, for your amazing overview of your predictions in the coming months. We polled our audience in the beginning here, and optimism was on the rise. So your optimism is appreciated, my friend. All right, let's jump into it. We'll try to get to as many questions as possible. So if you haven't dropped your question into the Q&A box at the bottom of your screen yet, and you want to ask Scott or Rita a question, drop them in there. Scott, what a quick question here around your presentation on the slides. They were asking what's the typical demographics of the consumer when you were talking about consumer purchasing?
Yeah, so macroeconomists are guilty of looking at a very aggregate picture. So that consumer spending metric that I put up on the screen, that's all U.S. consumers and all consumers spending in the U.S. economy. And so it's an input into the GDP reports that come out on a quarterly basis. So it does kind of lump everybody together. We are seeing more pressure on lower income households, as you can imagine, with struggling with the higher prices, the high rent growth, the high gasoline prices and food prices. They're getting squeezed a lot harder. But overall, the consumer, which is what we use for kind of our overall consumer spending forecasting, still looks quite solid. There's still a lot of momentum. people haven't used up all of their pandemic savings at this point. There's still some reserve left. And quite frankly, as inflation comes down over the next several quarters, or hopefully we're keeping our fingers crossed, that's going to help out on the real income side. So if you're able to hold on to your job over the next 12 to 18 months, if you're a worker, or maintain your workers, they're going to be feeling a little bit better about their finances 6 to 12 months from now, because the price gains. In fact, I've already seen it in my grocery store here in the Bay Area. We're starting to see some of those grocery prices coming down. Not all of them, but some of them, which is a start. And I think we'll see more of that in the months ahead.
Great. Let's see. Another question. Do you see a significant reduction, Rita? I'm going to direct this towards you, but Scott, feel free to comment. Do you see a significant reduction in banks' technology spend for the remainder of the year? Also, are small banks more hit compared to the big banks amongst what's going on right now?
Yeah, I think marketing dollars and technology spend often, are your easier ones to pull back when budgets get tight. Having said that, our customers want to be digital, and they don't. If people want to go into a branch, it's usually because they like some of the employees in the branch, but they really want to have the convenience of doing everything on their phone and, interact with the bank when they want to. So I think that, digital spend, it's just critical to the strategy of most banks. And the larger banks spend an enormous amount of money on digital. The smaller banks, I think, have learned to spend wisely, and they form partnerships and work with other fintechs to try to stay on top of that digital game. But it is the name of the game going forward, so it'll still continue.
Yeah. Scott, anything to add there?
No, I'd agree with Rita. I do think, banks are heavily focused on the digital channels. In fact, the bank failures we saw with Silicon Valley Bank, some of that was driven because of this new technology that people are able to move money so rapidly from one institution to another. So the regulators are going to have to figure out a little bit how to manage that piece of it. But banks are not going to be turning tail here. We know that our new and our younger customers demand it. Our businesses demand it. Our small business owners demand it. No, and I think physical branches are still going to be there for those folks, but you're going to always have that digital option. And banks continue to spend not on new products and services, but also around cybersecurity, right? We're all worried about that now, especially with these new AI tools that are out there. How safe is my money going to be? I think the banks are going to have to stay on top of that. And they're one of the best in terms of spend on cybersecurity and in those areas to make sure that your money is safe.
Totally. I'm going to switch a small gear here because I know the entrepreneurs in our community are looking to learn a bit from your expertise here, in addition to yours, Scott. So Rita, what are some of the common mistakes you see startups and small business owners making them when it comes to financial management, and how can they avoid these pitfalls?
That's a great question. I think, early on, and it doesn't have to be with an expensive firm, but I think, kind of getting your books and records set up, it sounds really boring, but, knowing a good CPA and a tax person who can help you, understand, okay, I should set up this type of legal entity. I want to separate my personal dollars from my business dollars and really think of those a little bit separately, and then be able to, when you're out looking for credit, be able to talk about those separately. And it's hard to do. And it's funny because Roxanne Byrne's going to give a talk on Thursday, and she always says, as Paloma reminded me, make sure you try to pay yourself as a business owner. So there's that. I think the other thing, and especially in this kind of environment, sometimes the build it and they will come, or I bought a boatload of inventory and then, in hopes of sales. I think you have to be, which everyone on the line knows better than I do. You have to be this sort of scrappy and and resourceful in how you spend when you have limited resources in those early days. But I would say overall, lean on advisors, and whether they're, and even in your unpaid advisors, people in your network that just like you, want to help you, and are willing to sit down with you and give you some, hey, I learned this along the way. And I would definitely, tap on all those resources.
Sound advice. Scott, back over to you. Somebody was asking about what are some of the trends that you're seeing in the transportation industry? And any predictions?
Yeah, so I guess it's your definition of transportation. If it's public transportation you're talking about, they're in big trouble because nobody's taking public transit anymore in these center cities that are dying. We're still seeing pretty healthy demand for autos and motor vehicles, but we do expect that to continue to soften as loan rates on autos continue to rise. If you're thinking about like the aerospace industry, Boeing has enough orders now to last them for another 5 to 10 years in terms of backlog. So yeah, we do expect some of those orders to be pulled by the airlines, but there's still a lot of demand there. And I'd also say with just some of the technological changes we're seeing around climate change, the new bills like the Inflation Reduction Act and the CHIPS Act, we're still seeing a lot of interest and demand around spending in some of those areas. So if you're a business that can take advantage of some of that spend, I think that's a good way to go. I would talk a little bit about, to transition a little bit, Colin, how would you as a small business, what would you do to try to survive the next 12 to 18 months? I think one thing you want to do is take a second look at your monthly cash flows and your balance sheet. To Rita's point, make sure you have a little cushion there for any unexpected drop in sales. Now, we're still predicting a pretty mild downturn, but once a recession starts, it's really hard to predict when and how deep it's going to be and when it ends. So you want to err on the side of being a little bit conservative. And to that point, make sure you're kind of right sizing inventories and you're monitoring those inventories on a pretty periodic basis, so you're not stuck with a lot of merchandise or stuff you can't sell. Also, with the input costs still being very high, you got to watch those labor costs. So look at using technology or a third party to help reduce some of your later costs. Maybe you can even take advantage of ChatGPT for some of your small business needs, and maybe not have to hire that other office worker. So there's a lot of things you can do at the margin. I also say take a look at some of your expansion plans. Hopefully you haven't put all of your expansion plans on hold, but make sure that given the current economic and financial environment of slowing in business spending, you're right sizing that as well. And the other thing I'd say is, again, maybe focus on those products or geographies that you think may be better insulated by the economic cycle. Like I said, there's always some products or services or geographies that are going to be better off than others. Right now, we're seeing some additional weakness on the coasts, given the tech exposure, but we're seeing still pretty strong growth in the Midwest and southern states, for example. Texas and Florida are two that come to mind. So you may even want to target a little bit more on the sales side as well.
Great. Well, I was going to ask you for a key takeaway, but that sounds like one to myself. So thank you so much, Scott, for sharing all of your insights and expertise today. Rita, thank you so much for also sharing your insights and expertise and for facilitating an amazing conversation. For those of you still on, we hope you join us for the rest of our Bank of the West events this week. We've got a bunch more on the horizon, as Rita had made the teaser with Rock. She's been on our platform a bunch of times. But Scott, Rita, thank you so much for joining us.
Thank you. This is great.
For those of you who are still on, we look forward to welcoming you back online soon. Have a good one, everyone.